Hi everyone, Ali here on Saturday, March 6, 2021 with a stock market update on most recent volatility in this market and what to expect in the coming days. So here I have some of the widely followed ETFs like Dow, S&P 500, Nasdaq 100, mid caps, small caps, some sectors of S&P 500 and ARK funds. So we know that the market hit all-time high a couple of weeks ago, and you'll see that Dow and S&P 500 didn't pull back that much from its highs. However, Nasdaq compared to Dow and S&P pulled back quite substantially, and more notably, the areas like tech, consumer discretionaries, biotechnology pulled back quite substantially, and hyper growth stocks like in ARK funds, they took quite a beating. Now, why is there so much volatility in some of the areas like growth? So let's look at some of the reasons. There are three, and the first reason is rising bond yields. So over the past, since the past August 2020, bond prices have been coming down. So the bondholders are going to get a fixed interest rate, but when the prices go down, the yield or the percentage return of the interest that the bondholder will get is goes up. So bond prices are inversely proportionate to yields. And if you look at the most recent activity, you'll see that the price drop was quite substantial and the increase in yield was quite steep. Now, how does this um, impact stocks and what does this have to do with stocks? That's reason number two. So one of the areas or traditional uh, ways to value stocks is using a discounted cash flow model. So what a discounted cash flow model does is quite simply is taking future cash flows and using an interest rate to bring it to present value, and that's how they come up with what a value of the stock should be. So now if the interest rates are increasing out in the future, so the future cash flows, when discounted at a larger rate or a higher rate, will be discounted to present value and it's going to be lower. So if the interest rate is, let's say, 1%, the discounted present value will be different. But if the interest rate goes to 2%, the value discounted at this point in time will be cut in half. So that's impacting all the growth companies which have cash flows out in the future. And that brings me to point number three. So growth companies, starting with second bullet point, growth companies have higher revenue and earnings growth, but most of their cash flows are in the future. So now when you discount them to present value, their valuations go down. And because the interest rates are going up, large institutions and money managers, they look for opportunity in other areas where the valuations are much cheaper. So that's one of the points. And then the other reason is for this rotation is because we're just coming out of the pandemic and there is reopening of the economy, and because of that reopening, there is an economic expansion and recovery. So consumer cyclicals or cyclical companies, they benefit from they benefit from the economic expansion or recovery in the economy. And then we know because of reopening, there is a lot of pent up demand and large savings people have, which they are going to utilize. And then the biggest beneficiaries of this will be banks, energy companies, industrial companies, or consumer discretionaries. And finally, some of the companies like financials, they benefit from rising interest rates as well. Now, if we look at ARK ETF, and I have 20 top holdings of ARKK, um, and you'll see that a lot of companies from its most recent high sold off 20, 30, or 40%. And and in this column over here, forward price to earnings ratio, these are still very high multiples for these companies. Like for instance, Roku might be growing very fast. However, when you look at the multiple that people are paying, they're paying $631 for $1 of earnings out in 2022. So that's what this measure means, and you'll see how do these numbers compare against some of the Dow components. So you'll see most of these numbers over here are in hundreds or 200s or 600 in terms of Roku. And if you look at like one of the hottest areas recently, like electric vehicles, then you'll see that a lot of these companies don't even have any earnings, or some of the companies don't even have any sales, um, and they're valued in billions. Um, but when we look at Dow components like Apple, Microsoft, J.P. Morgan, Johnson Johnson, these companies have real cash flows now, and their valuations are quite cheap. Like for instance, Johnson Johnson, you're paying $15 for $1 of Johnson Johnson's earnings, and that's why there's been this rotation going on from growth into value, and especially during the rising interest rates. Now, looking at some of the charts, S&P 500, you'll see that we have this trend line from March lows last year, and last week S&P 500 did actually break it, but closed above it. We will see what happens in the coming weeks, just so that we are mindful how far we've gone up in this past 1 year. In 2018, right before the trade wars sell-off, the market was 20% higher than its 200-week moving average. In February of 2020, S&P 500 was 21% away from its 200-week moving average, and presently we were 25% away from its 200-week moving average. So the market has run up quite substantially, and it's going to take some time for these moving averages to catch up to the market. And a lot of growth companies, they don't really have a lot of cash flows right now. So Nasdaq 100, similar trend line from March lows. Nasdaq has already broken it, um, and then it found support at its next level, and it bounced back up, and it closed above the 100-day moving average. So let's see in the coming weeks if it's going to hold it and continue going higher, or is the sell-off going to continue, because there are a lot of growth companies in this ETF. Now, looking at QQQ's weekly chart in 2018, Nasdaq was 27% from its 200-week moving average. In February of 2020, it was close to 30% from its 200-week moving average, and that's where, after the sell-off, that's where it found support in March. And right now, 2 or 3 weeks ago, the market was close to 39% away from its 200-week moving average. So again, a lot of um, increase in value over here, and let's see how it does in the coming weeks. However, now stepping back and looking at the big picture, here is a chart for interest rates over the past 20 years. Interest rates have consistently been going down over the past 20 years, and if we look at it in 2019, interest rates were close to 3% in 2019, and that's where they peaked. And right now, they're at 1.5 or 1.6%. So they have run up quite substantially, but let's see how they impact the market, and if it's a temporary impact. And just to focus on the big picture again from a market perspective, you can see how the market has been performing over the past 20 years or so. There have been times when we've had these big corrections, like during the dot-com bubble, during the financial crisis, and most recently because of the coronavirus, we had this V-shaped recovery. But now we've had growth companies run up quite substantially, and there are a lot of monies moving out of growth into areas that are going to benefit from the reopening of the economy. Now, summary to all of this is that markets are designed to go up. Indices will keep adding growing companies like Tesla, and they'll keep removing left for dead companies like General Electric, as Dow removed GE from its index. And that's how indices keep going higher and market keeps going higher. The second thing to keep in mind, there will be periods of extreme volatility, and that's when you want to have some money on the side where you can invest and take advantage of these pullbacks. Since 1945, in this chart below, you will see that there have been 5 to 10% declines 84 times. There have been 10 to 20% declines 29 times, 20 to 40% declines 9 times, and 40 plus percent declines 3 times. And these are the times, if you have cash available, you can take advantage of these declines. And during these declines, a lot of speculative companies, a lot of growth companies, they're the ones who sell off the most. So the final point here is you should maintain a well diversified portfolio. And if your entire portfolio is made up of, like, let's say all your money is in an ARK ETF, or your majority of your portfolio is made up of companies that are speculative or growth in nature and have earnings that are way out in the future, then your portfolio will probably take a hit quite substantially higher than what S&P 500 is going to do. So maintain a diversified portfolio and try to take advantage of these sell-offs. And I wish you all the best in these coming weeks. Bye.